El-Erian of Queen's College, Cambridge. Mohamed, what a privilege to round out this week with you, and what an interesting week it's been. Can I just start in the Treasury market? Yields aren't falling. Treasuries aren't rallying. Yields are rising. Treasuries are selling off. Mohamed, what's going on there?
What's going on is that the marketplace is recognizing what you and I have spoken about, is that inflation is sticky, and that the service sector in particular in the US economy is red hot. So we are pricing in more Fed action, and we're also pricing in, ironically, John, that this will end up being a Fed policy mistake. So in addition to the yields moving up, we've got a two-stand inversion now that's at 75 basis point. So you're getting the sense that the Fed is going to have no choice but to hike rates even more, but that will end up risking a recession because the Fed has started so late, and the marketplace has now embraced that possibility. We were just reflecting on the debt ceiling saga at the moment. Mohamed, how different is this one to the one that you lived and breathed at PIMCO 10 years ago with 5% CPI? It's different, John, because of the working assumption. At that time, we did not have the working assumption that this will get resolved. Most of us in the marketplace assume that this will get resolved. It doesn't mean there aren't longer-term costs. There are. There are three in particular. One is you erode trust even more in policymakers domestically. Two is you divert politicians away from the work they're supposed to be doing in order to enhance growth, enhance productivity. And third, you signal to the rest of the world that the US economy is less predictable. So, even though we're going to resolve this, and I believe we are going to resolve this, there is longer-term damage being created. I want to borrow a phrase of yours, risk mitigation characteristics. Do you think this erodes the risk mitigation qualities of treasuries? It does, John, because it comes on top of many other things. Third countries, what Jared Cohen of Goldman Sachs called geopolitical swing states, they can go either way, are getting worried about reliance on the US debt markets, about reliance on dollars. And unfortunately, the very well-intentioned and necessary sanctions on Russia, I want to stress they were necessary and they're well-intentioned, has pushed Russia into creating a small ecosystem, as cumbersome as it is, that bypasses the dollar. So now countries are thinking, well, maybe it's not as non-feasible as we thought initially. So the last thing we want to be doing in the US is giving people excuses to look for little pipes that go around both the dollar as a reserve currency and our debt markets. Well, you introduced the US dollar, so let's go there. Do you think the dollar crisis is over now that the dollar started rallying again, Mohamed? Now, I say that tongue-in-cheek, but we have had quite a move from 110.95 on the single currency all the way back down to 107. Correct, because the interest rate differentials have moved in favor of the US of the last month. John, you know this. We've moved 90 basis points higher on a 2-year in just over 3 weeks, 90 basis points. It's amazing. I'm looking at the moves right now. We're almost at 460 on a 2-year. So this is the 11th day that yields have been climbing consecutively, 11 days straight. I go back to about 390 on May 11th, so that's something like 60, 70 basis point move just over that period. Mohamed, I was looking at the UK gilt market as well this week. The 2-year there, up 54 basis points this week. Now, Mohamed, I think some people reflecting on the UK and the experience of September, October time, and a gilt crisis, if we can call it that, do you think there are maybe things starting to come together that remind you of what happened in that period? Well, there's some fundamental differences, as you know, John. Back then, it was a fiscal policy mistake. Today, it's in response to not just headline inflation not falling as fast as people had expected, but core inflation going up. So there's now a recognition that the Bank of England is going to have to hike, and the market has priced in a peak rate of 5.5%. So it's not fiscal driving this, it is anticipated monetary policy. That's issue number one. Issue number two is that this is not viewed as a crisis. This is viewed as a chronic adjustment to higher inflation. And therefore, and this is important, therefore, the longer-term growth effects are going to be more detrimental. Mortgage rates are already moving up. Nationwide announced this morning 45 basis point increase in the mortgage rates. So this is going to make stagflation more likely than not in the UK, unfortunately.
There's the word, stagflation. Just for the UK or for others too, in Europe as well, given the disappointing data we've had out of China?
So, when you go away from the UK, you don't have an 8.7% headline inflation. It's lower in Germany, it's lower in France. Now, we know that the German economy is already in recession. So, yeah, you may get stagflation light. The US is the one that should avoid it unless we get policy mistakes. So the US is the outlier in all this because its domestic economy is much more dynamic, much more resilient, and also much hotter, if you like, than elsewhere.
Mohamed, I just wonder how you'd characterize the inflation growth mix then in the United States, given the data we've had. We've talked about this a few times, both online and offline. You look at manufacturing data worldwide right now, it's screaming downturn, cut rates. You look at services, it's screaming hike. What is the kind of growth inflation mix you're expecting now?
So the inflation one is very straightforward, that because the Fed was late, inflation went from a few items to the goods sector and then got embedded in the service sector. And that has two results. One is it makes inflation less sensitive to interest rate increases. And two, it makes wage inflation more likely. So when you get that migration, and that's why economists hate a central bank falling behind, when you get that migration, you get a dualistic economy because interest rates will hit the goods sector, starting with housing, but will not impact the service sector as much. So that's what you get for a while, and then it depends on what central banks do. And that's why, John, the yield curve is inverting more, because the market strongly believes that the Fed is going to hike once, maybe twice more, and then it's going to have to reverse its hikes later in the year, because this will prove to be too much for the economy as a whole.
Final question then. Where are you for June and beyond on the Fed now?
So, John, what they should be doing, as you know, is they should be recognizing that the monetary framework is not fit for purpose. They should be recognizing that the inflation target of 2% is the wrong inflation target. And they should be implicitly aiming for a higher inflation target until the time comes when they have the credibility to change the inflation target. That's what they should be doing. And if that's the case, they would not hike. But I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike, even though your policy measures have a lag in terms of effects. And this is also a Fed that's so worried about its credibility that it's not going to be wanting to fall behind even more in the perception of people. And it doesn't have the confidence to stand up and say, look, we operate with a lag, and we don't want another policy mistake.
So just to be clear, as things stand, just to wrap it up, I know we've still got CPI still to come before that decision, payrolls as well, but as things stand right now, you think they hike in June?
I do, and the market thinks they hike in June.